What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. Today's date is November 2nd, 2020. This is the show that I do Monday through Friday with my sidekick, Coco, over here. I'll throw up a picture. We use technical analysis to really help us determine where the stock market might be headed next. As well with that, we also look at multiple indicators. We look at commodities, like I said, the indices, and yields and currency as well. In today's episode, unlike the previous one where we looked at really big picture time frames, the monthly charts, we're going to hone in on the daily time frames to really kind of get a good idea as to what the market is thinking running into this election. Also, there's a sector that is really setting itself up for a potential run, and we're going to be looking at that as well. I want to thank everybody that has been coming into the channel, new subscribers, and some people that might be subscribing here in the near future. I really appreciate the support, blah, blah, blah. Whenever you hit that likes button, whenever you comment, whenever you engage, I really, really do appreciate it. And at the end of this video, I do have an announcement. It's nothing crazy, but I'll wait till the end of the video. Let's go ahead and just hop into today's show. Alrighty, welcome back. So what we're going to do first is we're going to look at the indices, starting with the S&P 500. Now, what I want to point out that has been going on, clearly we all know there's been a lot of fear in the market leading up to the election. We've looked at seasonality charts. It somewhat mimics what we've been seeing. Little different, but it has been quite similar. So from really October 12th all the way down to the end of October to the beginning of November, we've been seeing a pretty steady decline. A lot of fear in the markets, but is it misguided fear? Well, potentially, okay? We still have a little bit of uncertainty here, but on this chart, what I want to point out is this double bottom that's taking place. This could be argued that it's not quite a double bottom, but you can also argue that it is. And we're starting to see a little bit of a bounce from here. Now, that doesn't mean that we're going to go up and retouch this channel. We could potentially put in a lower high. Keep that in mind, which would not be good for the bulls. But let's look at the moving averages here. We had a little bit of an update today, up 1.23%. We did not recapture the 5-period EMA. If you're not familiar with the 5-period EMA, that's a frequently tagged exponential moving average. So it just helps us determine a short-term trend. So when we're above it, the bulls got control. When we're below it, the bears have control. When we're overextended tremendously or not even touching it, it's likely to see it snap back eventually to hit that moving average. Now, right above us, we have 3 open gaps to the upside. This previous day, we had a nice hammer candle and a bounce from this lower trend line. I would say, yes, we should start worrying, maybe potentially a little bit more, looking for major areas of support if we start breaking under 32.25 to 32. Let's just call it 3,200 would be the safest bet right there. It looks like it acted as support many times in history and right through here. Sorry, when I say many times in history, I mean looking back at the chart right over here these days, and then it acted as resistance as well. So let me clarify that. So as I see it right now, still the bears have kind of control on this big downward move. The 20 period is above the 50, but it looks like it's about to be crossing over. That's an intermediate term trend. The 50 period is kind of curling over itself too. Not looking all that great. We might very well see a short-term bounce and then potentially turn into a dead cat to head lower. But we'll be looking at some indicators to help us really determine what's going on behind the scenes. But first, let's go ahead and look at another indice, the Nasdaq 100. What do you know? Very similar, not up nearly as much today, up 0.29, but it's still a red body candle. We came into the 5-period EMA, got rejected. You look at the MACD, we're still trending down. We're below 0 on the daily time frame. We have a couple gaps above us. The 20 period sloping down, the 50 period is kind of curling over and sloping down. The bulls have a lot of work to do to be able to overtake this current short-term trend. It's not looking too hot, but that doesn't mean that they're going to give up at this particular point in time. Now, keep in mind at the end of this, when I go over my little announcement, which is really nothing, but then I'm going to also help conclude kind of my thoughts at the very end as well to just give you a good idea as to where, my money's at and what I'm thinking about doing. Here's the IWM. This is the Russell 2000. And we had this big gap down. We're kind of moving up. This was up 1.78%, not too shabby for the small caps. MACD trending down, but it looks like it's trying to curl itself over before it all gets down below zero. Have a couple open gaps, like I said, below us. We closed pretty much right above the 5 EMA, right sitting on it. So bulls have a little bit of a control here, but we're still swimming up a little bit of a river. So this red horizontal line I wanted to draw out because that should act as a pretty strong resistance if we come to close this gap. That means the gap starts at 156, where you already see resistance. We very well, it's been seen many times when the gap or the resistance is too strong and or support, what typically happens in the afternight markets is we get pushed above it and we either just gap and clear it, or, gap over it and then fall back down. There's various options that can potentially happen. But right here at the red horizontal line, 158, clearly where this gap window would be closed and a prior history of resistance. Already have 1-2 hits of resistance. Then when we broke above, it acted as support here. Then we gapped down. So this line at 158 has historical data points. So it should hold true. Once resistance is broken, it becomes support. But once support is broken, it then becomes resistance. And here, as you can see, it was support. And then what it took place? Well, we had that gap down. So sometimes that happens, like I said, after hours. Here we go is the INDU. This is the Dow Jones Industrial Average. The Dow Jones up 1.6%. Not too bad. Still below the 5 EMA. We had, I didn't draw in the gap right here, but we did gap up today. Nice hammer candle. Now, this actually created a lower low than the low of September, which was actually pretty bearish to begin with. Now we have the 20 period sloping down, the 50 period sloping down, hasn't crossed over yet. We have this overhead resistance where the gap kind of cleared. We have this gap back here as well. So the bulls have just a lot of work to do to make up for this move to the downside. So keep in mind, coming into all this market uncertainty, it's going to be probably pretty choppy. We're going to conclude at the very end of this show kind of where my head is at and where my money is going. I want to look at the S&P 500 on the 30-minute time frame, and I'm going to try to stock a little bit shorter on, the most of the rest of the charts here, just so we can wrap this video up and try to keep it as short as possible. But I wanted to point out a potential for an inverse head and shoulders here, kind of basing out. The MACD's looking somewhat strong, just recently crossed above the zero, have some open gaps. If we start breaking above the neckline, I'd say the neckline is at 3340. That would really set us up to go back up to 3390 to 3400, where this gap would be closed at that particular time. So keep an eye out on this one. It looks very plausible, but like I said, we're going to be going to look at some indicators, and I think they're going to really help you determine where the market might be going next. Now, I talked about a sector, and the sector that I wanted to talk about was materials. Materials sector has been doing quite well as of recent, and also the energy sector too as well. But I talked about the energy sector a couple market briefs ago, and I'm looking for opportunities there, and they've been really doing good, especially today. The energy sector did quite well today. We're seeing some strength, but as you know, there's people like CNBC came out and said, I think it was Squawk Box that tweeted something about it just being a dead sector, which typically means the opposite. It means we'll probably start seeing some strength there. Now, that's just me speculating, but I want to talk about the junior silver ETF. So these are silver miners. This is the weekly time frame. And now I'm a big bull on the prices of gold and silver as well, especially the miners. And a long time ago, I did a weekly scan special edition, and we marked it out when it was a very similar type looking pattern, and we caught the entire ride up. It was quite some time. And I think it was actually right around here. Then we caught that run up right there. I don't remember exactly when it was. But here is the SILG, junior silver miners, more volatile, right? But what I want to point out is this bull flag and this consolidation. So it came from a high of 17. Now we're floating around 14. Okay. Big volume on the move up, consolidating on the way down. What you need to wait for here is confirmation of a breakout. Now, what I really like about this is we're pushing up against the 20 period, the 5 EMA, and the 10 EMA. What I like to see is the 5 EMA above the 10 and the 10 above the 20 and the price action above. If we start seeing a break above this trend line on high volume, this is something that I will be entering into, or I'll be looking at individual silver and gold miners to be entering into on this specific breakout. So the materials sector is where this is coming from. Materials, like I said, have been doing quite good. But overall, the miners and the gold miners industries within that sector have not been performing all that great. So materials is looking strong. I'm looking for some value there, and the value that I'm kind of seeing is around gold and silver mining companies because of their long period of consolidation from their highs. So we're going to be monitoring this one. And if you don't follow me on Twitter or Instagram, you can follow me there, and that's where I'm going to be posting most of my intraday alerts. It's time to talk about the indicators now. The first one I want to do is the CPC. This is smoothed over a 10-period moving average. I use this and have been using it as a sell signal. When the black squiggly line over here, to be technical, right, crosses above the 0.8 from going under, then crosses above, that's the sell signal. As you can see, if we look straight down, boom, killed it. Great indicator for that right here. Crossed above, boom, headed a little bit lower. It doesn't tell you how low it'll go or if it's going to crash or not, but what I'm showing you this for now is because it can also technically be used as a buy signal. When it crosses above 95, that means, okay, get ready. And then when it crosses back below, that means it is a buy signal. That doesn't mean go super long or do anything like that. Just like the sell signal doesn't mean, get out of Dodge. What it means is just take some profits off the table here. And what you might do here is you'd look for charts that look like they're about to break out because there's a high probability for them to break out when you have more ideals in your favor. So a potential buy signal here in the near future. So I'll be keeping a close eye on this one. This is the CPCE. It's an indicator I put together I've originally got this from a trader and investor named Greg Capra. But this is a little bit different, not by much. But really what it is the CPCE inverted, okay? So you're probably confused if you're wondering. This is a put to call ratio. But what I like about looking at the CPCE versus the CPC, which we just looked at, or the CPCI, is the CPCE is built of just the equity options. And equity options means individual, stocks that are buying puts and calls, and it helps us determine that ratio. And this is really, in my opinion, more of a contrarian indicator. And the reason why it's a contrarian indicator is because you have a lot of retail traders trading this. This is a lot of information built from people that are not professionals. So how do you read this chart? Well, there's a couple envelopes here. You can see the moving squiggly red lines. And when it gets into those areas, it means it's kind of overextended relative to where it is in history. So, or to this moving average. So as you can see, sometimes it gets super extended. And what it means when it gets overextended on the top side is that means dumb money is buying puts. Okay, dumb money is buying puts. Why dumb money? Well, it's retail traders. Okay, this is a contrarian indicator. So when dumb money is buying puts, smart money should be buying calls. Now, if you just look down, when it got super overextended, the dumb money was buying puts at the bottom of this of the S&P 500 here, and then we started moving up. Now look throughout history. We'll look over here. Dumb money buying puts right here on the move down, a little bit of a scare, and yeah, the scale's off a little bit, so it's hard to see how big of a move that was down. But then we moved up right here. More familiar with 2018, right? Got overextended over the second envelope, buying puts with all that fear. Boom, we moved to the upside. Here and here, same thing. Buying puts at the wrong time, shot to the upside. Buying puts at the exact wrong time, boom, shot to the upside. Boom, boom, same thing here. You can't really see it because it's kind of squished, but they both moved up during those single times. Right here and right here, same thing. You bought puts, it moved up, and then it came back down, and then you bought more puts in the overextended area, and then that was right here, and then we moved up. Now what do we see? Well, we're right here in the overextended area again, meaning dumb money is buying puts. Okay, so there's a lot of fear here, which drives retail traders to jump into this fear and potentially, yeah, could they be right? Obviously, they can all be right as a whole, but as history says, and what history typically tells us, is they're wrong, a solid 90%, 95% of the time. So when we get super overextended on this double bottom, finding support, this kind of makes me think, okay, it's probably time to actually play into this. Now we have uncertainty ahead of us, so there's a big wrench in this, but the technicals are telling us right now there's more dumb money buying puts than potentially smart money. So something to keep in mind. Here's the VIX. The VIX is considered a bull flag. We broke this neckline, could very well still continue to head up. We're holding on this neckline, still have a gap below us. If we move higher, that's going to put a lot of pressure on the equities, right? So what you want to pay attention to here is why. So we've been up here with heavy volatility, and then you've seen things all move, and like we've seen stocks go down with bonds. So there's like no flight to safety. What you're seeing here, when the VIX goes up and we're trading within high volatility, you have a lot of new distribution taking place. So you have a lot of probably algorithms, probably a lot of hedge funds redistributing what they're planning to do during these high volatile times. When volatility is high, you typically want to take risk off the table or readjust and reassess whatever is being taking place in that individual portfolio. So you see things like, gold go down with the dollar. You see equities go down with the dollar. You see everything kind of just go down as people are selling off things and moving into, cash or whatever the case it may be. So the last couple trading days, the last week or so, you've obviously seen a lot of different things go down. Why the volatility has been rising and just kind of sitting here between 35 and 42. If we start moving higher, equities go down. That's what's going to happen. Now we got a little frothy here, so we kind of pulled down, but we're still holding strong above the neckline. So, if the indicators are right, what I showed so far, it's very possible to see the VIX come down and then we see the equities bounce. But keep in mind, there's no clear direction here. This is a bull flag. We're above the neckline. It's very possible those other indicators, they're not giving us the accurate information if we start moving higher here on the VIX. Here's the S&P 500 with the CPC smooth over a 10-period moving average. I've shown you this on the previous videos, but as you can see, it's kind of holding this level of support. Recently just broke down. This is what I previously kind of just showed you, just in a different light. When it pulled down here, that was dumb money buying puts at the wrong time. Now, this is by no means an overextension when you compare this moving average throughout history. So dumb money buying puts, and we started moving up higher too as well. Is this dumb money buying puts at the exact wrong time? Will this head lower, but this will head higher? It's possible. It's very possible. But like I said, throughout history, this isn't by any means an overextension, but this is moving into 1.0, which means, it's getting more technically bullish sentiment than bearish sentiment. And, for example, when it was more bearish up here, like I said, this is an inverted scale here. So when we're up at 0.75 over here and over here, that was dumb money buying calls at that specific time. And as you can see, those were at the peaks. And then now we're seeing these double peaks, and now we're seeing a third one right here. So it's interesting to see. Will we head lower? It's very possible. But the reason why I'm showing you this is because there's a historic little trend line or support right here where we very well might be, being told that the market is getting the equity side of the market. The retail traders are getting bearish potentially at the wrong time. Another indicator that can show us that is this little double bottom here on the NYMO. This is a breadth indicator. So we're looking at breadth and we're looking at sentiment. We're kind of hitting it from all levels. Double bottom right here. Now we're at minus 26. This could very well be the spike to the upside that matches 2018. As you can see, negative breadth to a spike, negative breadth to a spike, negative breadth to a spike, negative breadth to a potential spike. You can look at the price action here. It's very similar. Down, up, down, up, down, up, down, potentially up. Okay, so I've been pointing this out on multiple market briefs. We need to keep a close eye on that one. Last one I want to point out that can potentially lead me to believe that we're overextended and a bounce can come into this election or even into the beginning part of November is we're overextended on the BPNDX. Again, minus 28.56. It could head lower. It can. But keep in mind, when things get overextended, it's likely to see bounces. Now we're running into an area of support on the NDX. We're running into overextended here, which means we could potentially see that bounce. Now, when he got overextended here to the upside, that was right here, and we pulled down. Had a bullish divergence right here on the downside. That was when we ran up. Okay, this has happened throughout the chart. Multiple times I pointed out multiple bullish and negative divergences. This is a good indicator, and right now, what it's telling me, short-term bullish, we're going to see a bounce. And like I said, I'm going to conclude this at the end, kind of help you understand where my head is, because this is by no means me saying, okay, the market's going to run up forever or go super high. That's not what I'm trying to say, but I will talk about it at the end. Let's look at commodities very quickly. Gold consolidating within this falling wedge. waiting for a breakout above this and recapturing the 50-period moving average. When we do that, I'm thinking that we can head higher. Till then, I still want to capture more shares down here by the support and this 200-period moving average, or at the lower portion of this falling wedge, just to get a better entry. But if I miss that, then it is what it is. We will see, though. Silver, we broke out of this ascending triangle, and now we're really just trying to recapture some ground here. Going to watch this one closely, but nothing really taking place much today. Up 1.64%. Pretty strong day from this previous bounce. But like I said, we still have the 50-period above us and this previous support or resistance, I should say. It's resistance now, or it is resistance. So if we start moving up higher, I would expect to get rejected right around 25 anyway, unless if something, big happens. Bitcoin, you'd have to previously look at my previous market videos to really understand what I was talking about back here, but I'm not really liking what it's doing right now. It's kind of like this, you could call it maybe a bull channel, but it's more like of a broadening pattern where volatility is really increasing within this pattern. You can see these monster swings back and forth. And then you see the RSI, very frothy. It's been overextended. We talked about that here. We said it can stay overextended for quite some time. What I would have liked to see is more of a consolidation to the side. Maybe that's what it's doing. You can draw it out maybe a couple different ways. We're getting some support at 13,250. So if we start breaking below that, I'd say, 12,000 would be likely to come retest. It just makes sense to me. You see the MACD kind of curling over here. We're losing some momentum. Today's swing, we were down 1.17, but we were, above 13,750, down to 13,250. So we're seeing just pretty big swings right now in the price of Bitcoin. I personally think that it's possible that we pull back down to 12,000. I could be completely wrong there, but being overextended here, seeing the MACD crossover, doesn't seem to me like the greatest entry point. Let's look at the dollar. The dollar still kind of pinned between this channel. I think it's going to be like that. We're probably going to see some more momentum here right after the election or into the election. Break above 95, that would send us higher. That is going to put some pressure on equities if we start reaching up to especially 96, but that's going to be bad for gold. Bad for silver if we start breaking out. Now we have a little bit of an inverted hammer right here above this previous resistance. Now we're support. So we might potentially come back down into this lower part of the range. You got to watch out. If we start breaking below 92, then that's going to be good for the gold. That's going to be good for silver. That's going to be good for the miners. We'll see what takes place when that happens. But we got to see just a break out of this channel to really help determine. We had an inverse head and shoulders pattern. That's no longer. You can potentially still call this a cup and handles if you're really trying to, I don't know. Yeah, you can call it that. I would just consider it a basing pattern within this channel, though. So we got to watch out, see what takes place here in the near future with that. Really quick, we'll just dive into yields, and that's going to end it to our conclusion. Spread is at 0.71. This is the 10-year minus 2-year widely tracked spread. That typically means we're expecting higher inflation, good growth taking place. How high can this thing go? On the last market scan or the market brief, daily market brief, I did a big picture of the 10-year minus 2-year, and it was a very interesting chart. I would highly recommend you go watch that if you haven't done so already. This right here is the 10-year at 0.87, the 30-year at 1.63. Just notice the trend. We're trending up. The yields are going up, but every time we kind of get up a little bit, we come back and retest this trend line. So, we'll see. A lot of people are saying, I think, that they think bonds are going to be the big player here in the near future. And other people are saying, very, smart people are saying bonds are just going to fall through the floor. I don't really know. I'm not by any means professional understanding yields and bonds. I'm just kind of keeping a close eye on it just to help us really understand what the market is thinking. The great thing about technical analysis and intermarket analysis or quantitative analysis, you don't really need to understand all the individual economic data. The bond market, being how big it is, and even just the financials and multiple other aspects, it really helps you determine what the market is thinking when they read that data. So it's something to think about. The bond market really prices in a lot of that economic data, so it helps us see, when we know technical analysis, what to kind of expect. Now, 0.71 on the spread, you look back through history, it's been quite some time since it's been this high. I think it didn't show it, but I think in 2018 it was this high. So our spread is steepening right now at this particular point in time. And obviously short term, the 3-month and the 2-year, they're being held down there at basically 0, which the Fed's fund rate has been already said that we're going to be holding that near 0 to 0 till 2023. Not like they're going to be able to move up rates anyway, but you got to understand the amount of debt that consumers have, the government has, the federal has. How high can, and even corporations, right, for that matter, how high can yields go until we start really feeling the pressure and rolling back over? So that's all I got for you on this market brief. Just to conclude my thought process, and then tell you this, the announcement or special announcement. My overall thought process right now is this. First off, I am out of all equities. I'm pretty much out of everything. I'm in cash positions at this particular point in time. Nothing that can my portfolio can be impacted from the upside or the downside. So I'm not trying to time things by any means. I'm playing safe until I see some direction, and then I'll start moving back in. Okay, so that's the first thing. The second thing, what do I think is going to happen short term? Well, looking at these overextended indicators and looking at where the price action is on the indices, I believe that we're going to be seeing a short-term move to the upside. I think we're going to see a continuation to the upside. It seems that way. I could be wrong. I'm wrong all the time, apparently. So a short move to the upside, and I think we might start getting pressure, though, when we start running into those areas of resistance that I mentioned. So this could very well, what I'm thinking is a short-term bounce until the indicators level themselves off, and then typically you see a big run into November because of the seasonality charts, but it could very, very possibly, if we start seeing weakness in the candles on the daily time frame, weekly time frame, whatever it might be, if we start seeing weakness, this could all just be a fake out dead cat bounce. My overall kind of thought process is the market could head higher, trapping more people, and then we're going to start really seeing some pressure. And really to see that big picture, where I'm coming from here, you got to watch the previous market video where I talked about the big picture on those monthly time frames. Now, as far as the special announcement goes, I've been saying I've been working on a website. I got the website basically up right now, but there's just a couple old posts because I have a lot more information I got to start posting onto the website, but the structure's there. So, be nice. It's not that great. But the newsletter is getting set up as well. And the newsletter, if you want to sign up for that, that's going to be the place to go to see any updated charts throughout the day. I'll post it probably on Twitter, but I'll just have a link to the market dashboard, which I'll just be constantly updating a market dashboard. But the newsletter is where I'm going to be probably posting charts that I'm looking at or positions that I'll be getting into. So if you want to get alerted on, individual stocks that I'm looking at, by no means they're recommendations. I'm just kind of sharing my opinion. But you can go to figuringout.money. That's the URL. There's no .com or .co. .com was taken, which I'm in the works to try to get that website, figuringoutmoney.com. But as of right now, I don't have it. So figuringout.money is the website. Let me know what you think about the structure. Like I said, I'm new to this. I'm building the website. I don't have a professional doing it. So, be nice. But there's only like 4 posts, and they're all old just to kind of show you what it will look like. But figuringout.money. Sign up for the newsletter. And once you do, I'm going to try to send some emails here in the near future. You're probably not going to get any right away. And I don't plan on using it to spam anybody by any means. But check it out, and then I'll try to start practicing, sending out some of the emails or whatever. Gosh, I'm so new at this stuff, but I wasn't expecting to get 30,000 subscribers in 3 months here. So bear with me. All right, everybody, that's all I got for you on today's stock market brief. Hope everyone is having an excellent day and start to the month. Toodles.